Executive consultants, you're welcome. In our previous video, we looked at the first few stages that we go through when we are preparing our consolidated statement of financial position. And we had moved through the determination of our group structure. We determined the net assets, and we stopped when we had determined the goodwill. And the last bit that we looked at was we had to less the impaired goodwill from what the goodwill that we had so far for us to arrive at the total goodwill. Impaired goodwill, like we'll look on at in our subsequent videos. We'll be looking at IS 36, and then we'll get to know all about impairment of goodwill or even other assets. So for now, we are going to continue from where we stopped on, and we will proceed with the NCI, the group retained earnings, and then we'll fill up our consolidated statement of financial position, and then we'll see if we will have satisfied the accounting equation of assets equal to liabilities plus owner's equity. So let us go back to our work, and then we see how we arrive at the remaining two workings for us to be able to fill up our consolidated statement of financial position. So like you can see, we stopped at our total goodwill of 1,700, and now we are going to go straight into the NCI, the non-controlling interest. So when we are calculating the NCI, we know very well that we are going to start with the NCI's percentage share of subsidiary on net assets at reporting. Now we are looking at reporting, not acquisition, because we want to know the value that we have so far in our business as far as the NCI is concerned. And then because we started by the question, and they were telling us 3,500. So we want to see, after us acquiring, or after Facebook acquiring WhatsApp, how did the value of NCI remain? I must remind you that the value of NCI is simply going to represent the post-profit acquisitions that the subsidiary has made ever since it was acquired. And you must be knowing that the pre-acquisition profits of the subsidiary are not included in our workings. So what we are working right now, you can say perhaps we want to know the post-acquisition of the subsidiary, and that is going to be presented by the NCI, which will also add onto the consolidated statement of financial position to have our fully consolidation. So the NCI share percentage of the subsidiary at acquisition is still going to be the same. We are going to have our 25%, and then we multiply it with the total at the acquisition, which is 16,000. And once we do that, we'll have 4,000, and then we'll have to find out the goodwill of the NCI, which you already have as 500 here, and then we'll be good to go. So the total NCI would be the summation of the NCI share of S on net assets at a reporting with the goodwill of the NCI. And that means we have our NCI, our total NCI as 4,500. And then finally, we'll be looking at our working five, and it's going to be the group retained earnings. I must tell you that IFRS 10, like I was saying, it ignores, or because it ignores the pre-acquisition retained earnings of the subsidiary, and that's why we are putting 100%. 100% of the parent's retained earnings. And when we come back to our question, we are going to see that the retained earnings of the parent, which is 100%, is 6,000, which we will put here. And then the parent's share on the subsidiaries post-acquisition profits. And how do we get that? Remember, we had our post-acquisition profits of 4,000. So we'll simply come and then we put the 75%, and then we multiply it with the post-acquisition profits, which is 4,000, for us to arrive at the parentis subsidiaries, parentis share on the subsidiaries post-acquisition profits. And then like we did, because the standard tells us that we need to still less the goodwill impairment of 1,800. And once that is done, then we'll be arriving at the total group retained earnings of, we'll still do the same, we get the summation of the parent is 100% retained earnings, and then we add on its share on the profits, and then we less the 1,800 for us to arrive at the 7,200 as our total group retained earnings. Now, after us working out these workings, we simply need to come and fill them up. So working 3 will come and then fill up the 1,700. Then working 5 will also come and fill in the 7,200. And then we'll also come on working 4, of which is NCI, and we fill in the 4,500. So the rest that we are going to do are going to be the line by line basis. So we are going to add the 33,000 to 20,000. And when I press on my calculator, I'm getting, when I press on my calculator, 33 plus 20, I'm getting 53,000. So I will come and I will put 53,000. And then the current assets, I will come back and I'll put the 5,000 plus 15. That would be 20,000. And I'll put it here as well. And then I will need to arrive at the, I will need to arrive at the total assets. So I'll say sum, and then I'll simply do the summation here, and then I'll get 74,700 shillings as my total assets. And then I'll come back to equity now. IFRS 10 still tells us that the equity that we put in, or the share capital that we put in, is going to be 100% of share capital for the parent. Why 100% of the share capital of the parent? Is because the share capital of the subsidiary, in this case which is WhatsApp, is effectively cancelled out with the investment. So if you can see, we have 4,000 and then plus 12,000. This is going to give us 16,000, and then 16 minus 12, you're seeing the post acquisition that we got of 4,000. So we are simply going to ignore that 4,000, because the IFRS 10 tells us that we should only consider 100% share capital of the parent. So we'll come and then we put the 10,000 here. We'll put the 10,000, and then we see that we have share premium with 5,000. So we'll take on the share premium of 5,000 as well. And once that is done, now we'll need to have the total equity. So we'll still do the summation, and then we'll add up all these, and then we'll have our total equity as 26,700. Finally, we'll come to the liabilities. We have the non-current liabilities, the NCL, and then we have the current liabilities, the CL. So when we come back to our question, we can see that our non-current liabilities, we have 8% loan notes of 20, and then 9,000 in the subsidiary. When you do the maths, you're getting 29,000. And then we'll come and then we put it under the NCL as 29,000. And then we'll come back to the question for us to get the current liabilities, which is 9,000 for the parent, and then 10,000 for the subsidiary, which is going to give us 19,000. So, and then we'll have to get the total liabilities, So we'll simply come and then say summation again, and then we'll add these two for us to get 48,000. So when we get the 48,000, then we need to find out if our total equity and liability is going to equate to the total assets. So we'll simply say summation, and then we will come and then we get our total equity, then we add our total liability. And once we do that, you can clearly see that we have total equity and liability of 74,700, and then we also have the total assets of 74,700, and that makes our accounting equation of assets equal to liabilities and owner's equity fulfilled. So that is how we come up with a consolidated statement of financial positions. And we've gone through all the workings. And the next video, we will have to include some little bit of challenge. We'll bring in the how do we account for unrealized profits when we are working with the consolidated statement of financial position. Executive consultants, good evening.